Investing in cryptocurrency can be a great way to make money, but it can also be extremely risky. With its volatile nature, investing in cryptocurrency can be a daunting task. However, there are certain things you can do to become a better crypto investor, backed by science. Here are 7 things you need to stop doing if you want to be a better crypto investor. 1. Stop letting emotions guide your decisions. It's easy to get caught up in the excitement of investing in cryptocurrency, but it's important to remember to keep your emotions in check. According to a study by the University of California, Davis, when investors allow their emotions to guide their decisions, they tend to make riskier investments. The study found that when investors took emotion out of the equation, their investment decisions resulted in better performance. 2. Stop relying on gut instinct. It's tempting to rely on your gut instinct when it comes to investing in cryptocurrency. However, relying on gut instinct is not the best way to make investment decisions. According to a study by the University of Cambridge, investors who relied on their gut instinct had less success than those who used more analytical approaches. The study concluded that relying on intuition can be a costly mistake, and it's better to rely on evidence-based decision-making. 3. Stop being too conservative. It's understandable to want to play it safe when investing in cryptocurrency, but being too conservative can be a mistake. According to a study by the University of Oxford, investors who were too conservative often missed out on potential gains. The study found that investors who took calculated risks saw better returns than those who played it too safe. 4. Stop timing the market. It's tempting to try to time the market, but it's not the best strategy. According to a study by the University of Michigan, timing the market is a difficult task, and investors who attempt to do so often end up making poor decisions. The study concluded that investors should focus on building a diversified portfolio, rather than trying to time the market. 5. Stop chasing trends. It's easy to get caught up in the hype of a new cryptocurrency, but chasing trends is not always the best approach. According to a study by the University of Pennsylvania, investors who chase trends often end up making bad decisions. The study found that investors should focus on the fundamentals of a project, rather than just chasing trends. 6. Stop following the crowd. It's natural to want to follow the herd when it comes to investing in cryptocurrency, but it's not always the best approach. According to a study by the University of Toronto, investors who followed the crowd often ended up making bad decisions. The study concluded that investors should do their own research and make their own decisions, rather than following what everyone else is doing. 7. Stop overtrading. Overtrading is a common mistake among investors, and it can lead to poor performance. According to a study by the University of Chicago, investors who overtrade often end up with worse returns than those who don't. The study found that investors should focus on long-term investments and avoid making frequent trades. Conclusion: investing in cryptocurrency can be risky, but it can also be a great way to make money. To be a successful investor, it's important to remember to avoid certain behaviors, such as letting emotions guide your decisions, relying on gut instinct, being too conservative, timing the market, chasing trends, following the crowd, and overtrading. By avoiding these behaviors, you can be a better crypto investor and potentially make more money.